Good evening, everyone. My name is Vivek Soni. I'm a partner in EY's investment banking team. And EY has been partnering with IVCA since quite a few years. We've been the investment banking partner to this forum. And it's a delight to moderate this panel. One of the speakers in the earlier sessions had said that exits is really when the rubber hits the road. Exits is when you separate the men from the boys. And we have a very powerful panel here. Thank you so much for being here. And we are going to try and delve a bit deeper into what's happened with exits from a private equity lens from the last year per se, but taking a slightly longer view in terms of what's happened in the past 3 years, and do some bit of crystal ball gazing on what do we think might happen over the next 12 months across all the themes of exits, primarily being the capital markets, which is something that everybody finds very interesting, but also delving into the nuances around secondary exits as well as strategic exits, and also spending a bit of time on continuation vehicles and secondary portfolio deals. I would request my panelists to just give a quick round of introductions, post which we can kick into a bit of Q&A here, which I hope all of you will enjoy. Over to you, Vikram.
Hi, Vikram Chogle, work at Warburg Pincus. I've been at the firm for 15 years. I'm a managing director at the firm and head our value creation capabilities and group in India, as well as our capital markets activities in India and Southeast Asia.
Yeah, hi, this is Vishal Verma. I'm part of OGIF. I've been part of the firm for the last 14 years now. I'm an investment director. Now, kind of do a lot of things beyond investments, monitoring exit as well. So we are backed by 2 large anchors, that's a Sovereign Wealth Fund of Oman and State Bank of India. And of course, we have other domestic and other institutional investors in our fund. We're now investing from our 3rd fund. More to hear from us now.
Hi, this is Samir Shroff. I'm one of the co-founders of Fairing Capital. We are a 15-year-old India-based private equity fund investing in growth capital opportunities, largely across financial services, consumer, healthcare, and others. Over the years, we've raised over 700 million, made 33 investments, and exited 20 of them. So look forward to being with you.
Hello everyone, I'm Pancham Mukim. I head the private equity business for Everstone in India. Been with the firm for a little under 15 years now. So a long timer at Everstone. Everstone is a mid-market buyout fund, executing transactions in the $100 to $200 million zip code. That's a bit about us.
Hi, my name is Manish. I lead the enterprise tech and pharma and healthcare investments for Multiples Private Equity. Multiples, as many of you know, is one of the larger homegrown private equity funds focused on late-stage growth as well as buyout transactions across sectors. And we have been in business for more than 17 years now. I have been at Multiples for more than 7 years and have been in private equity industry for more than 20 years.
Great, thanks so much. So before I dive into the Q&A, just some background and context. In 2025, PE/VC exits showed a 17% increase, ending the year at $32.9 billion. And this is after an average depreciation of 6 to 7% over the previous year. So if you were to look at the rupee equivalent, you would have seen that exits would have increased by 17 plus another 6, almost 23, 24% over 2024, which is impressive. And this increase was underpinned by a big hike in strategic exits as well as exits via the IPO markets. But now we are looking at a very different time as far as the capital markets are concerned. There is a lot of pressure. Last year, the Nifty 50 gave an INR return of only 10.5%, right? So in dollar terms, India really lagged its Asian peers. Plus, there is a lot of volatility, a lot of repricing of risk in the mid-cap and small-cap, which is where a lot of the private equity-backed businesses, when they IPO, they go in for. But yet, despite all of this, the IPO window was open for most of 2025. But like I said, this year, it's going to be interesting times. We might see a few changes. So with that background, why don't I kick off with you, Vikram? Warburg Pincus has been one of the most prolific investors, one of the investors that's been around for the longest time. You've had a lot of exits across all kinds of exit routes through the last 3 years. Can you share with us, some of the nature of those exits? How do you approach constructing an exit via the public market versus not the public market? How do you think about the sizing and the timing?
So thanks, Vivek, firstly, for putting this together and for having us on the panel. I would say to contextualize the quantum and nature of our investments, I'll give you a couple of numbers. So we would have exited broadly $4 billion in the last 3 years. Of that $4 billion, somewhere just south of $3.5 billion would be public markets related exits. And those public markets related exits would be across 20 plus different block trades and kind of 10 companies, right? So I guess the first point I'd make is both by virtue of scale as well as kind of the distributed nature of the exits, we've been active on the exit front. I'd say secondly, when you look at the nature of these exits, they are largely public markets, right? And largely block trades. And for that, I'll offer a little bit of context. So, we've been investing in India for the last 3 decades. We would have deployed close to $11 billion of capital. And if you look, other than the last 4 or 5 years, I would say most of our deals historically have been minority growth investments, which is a barometer of the PE industry, right, in India over time. When you dovetail that with the fact that, the strength of Indian capital markets has only increased over time, obviously the market depth has increased. The resilience of the markets have increased given that domestic money and domestic flows have made markets a bit more sticky relative to fickle foreign flows, at least on the public side. And and therefore, I would say that IPO becomes a natural source of exit when you have a minority growth position. I would say in terms of our philosophy, we view an IPO, I'd say philosophically, more like a financing event for the company and a milestone up from the company, rather than an exit for Warburg. Naturally, creation of that public currency gives us a path to eventual exit. But our behavior and posture in the IPO is such that we rarely sell a large portion of our stake. So as a consequence, we were left with, post-IPO, a range of companies with large ownership stakes in, as you mentioned earlier, largely mid-cap companies, right? So the value of the stake relative to the liquidity on the counter is very large. And therefore, it kind of behooved us to be a little bit thoughtful on the architecture of those exits. Broadly, I would say kind of 3 things, right, in terms of how we approach this. Number one, really focused on helping the company articulate its own equity story and its posture towards the markets. Number 2, building the company's profile and credibility post-IPO, because that's kind of the most important. And number 3, I would say we make our attempt to use our direct buy-side relationships to help bring kind of the best-in-class funds, both domestic and foreign, into the cap table. I would say our approach on these public markets trades is generally to do it in a fairly disciplined fashion. And by that, what I mean is not just disciplined price from a fund's perspective, but also sizing it such that the likely aftermarket reaction is positive. Now, you can't always control that, but the attempt is to bring in long-term oriented investors into those blocks to hopefully, and in most of our cases, we are subsequently selling at higher and higher prices. So as you can tell, that creates a little bit of a virtuous cycle where people see folks coming into liquidity counters which are slightly lower. They see the positive reaction, and that kind of opens up more people to come in over time, right? Builds the profile of the company. So that's kind of the approach. I'll just make one other point, which is if you look at the nature of these exits, you'll see largely public markets in the past. I would venture that going forward, though, the shape of that may be a bit more balanced. Because the last 4 or 5 years, at least us, and I think this is, again, a barometer of the private equity industry in general, has been investing in more controlled deals. So that gives us a lot more degrees of freedom on how we will exit eventually. So I think you'll see a bit more balance between strategic sales and sponsor sales and IPOs and blocks. That would be my perspective.
Thank you. Thank you very much. Sameer, my next question is to you. Whether it's Anthem, Niva Bupa, or Go Digit, you had some great exits via the capital markets. And obviously, marrying the thought process around how much you would like to retain versus because of the belief in the long-term story versus how much you want to sell or have to sell because of the need to show DPI and whatever other metrics that are important for your firm at that point in time. So what's the rule of thumb or the discipline that you guys follow when you decide, okay, now's the time to book the exit, now's the time to get the DPI up versus keeping it for the longer term?
Yeah, thanks, Vivek. Over the years, we've learned a lot about how to sell, and you can only learn by doing. We've had 20 exits. I'd say broadly, over half of them were IPOs. Some were public market sales, some were strategic sales, and buyout sales. The most important thing for us is to have an underwriting case of how we will exit at the time of investment and be disciplined about it. So typically speaking, and we were very fortunate in 2025 to have 3 very large exits in Fund 2. Just in our exits in Anthem, Niva Bupa, and Digit, we would have sold roughly 900 crores out of a 1,300 crore fund in 1 year itself. So, what I would say is we can talk a lot about exits, but the most important thing is if the company does well, you have a lot of options and you can always sell, right? And we were fortunate to have these good investments. And in each of these cases, in Niva Bupa, it was a combination of a strategic sale to Bupa before IPO, and then we sold some in the IPO and some after. We've made over a 7x. So in that moment in time, we have to be disciplined that it's our fiduciary responsibility to return capital. We'd like to hold it for longer, but we want to keep returning capital because we've achieved our return objectives. Anthem Biosciences was a unique company where the founder held over 90% of the company at time of IPO. And it was just True North and our SOA investors. And he said, if you want an IPO, you have to sell. I won't sell, right? So again, sometimes you have to balance that with what the promoter wants as well. And it was, again, fortunately, a 4.7x return in 4 years. So there's something that we were quite happy with. And in Digit's case, we've sold about a third of our stake and at over a 4x. Now, when the capital markets are a bit under pressure and we see this company is going to keep compounding earnings over the future, so we're going to hold it for some more time. The other consideration that comes into play that's helpful for us, as opposed to, our friends at Warburg, we've done 3 deals with them. Our stakes are usually smaller, and we are structured as an AIF, which gives us an advantage of not being locked into IPOs at time of exit. That is a big regulatory advantage that Indian structured AIFs have. As long as we've held it for at least 6 months prior to the IPO, we can wait to see how the IPO lists. And typically, after all these exits, we now have it's a little bit of an art and science where we don't delegate this to anyone. Aditya and I, as founders, work on it daily, where we figured out a system of selling in the public markets with very small stakes without impacting the price, keeping the liquidity in mind. So usually it's a combination of all these things. And I would say that over the years we've learned that you have to remain disciplined about selling, because there's enough case studies where companies that we sold after which they didn't keep going up, and we're glad we sold them.
Excellent. Vishal, my next question is to you. Is that, like Fairing, most of your investments were also minority growth, and you've had some exits, whether it was Senco Gold, Stanley, CSFB, or Digby. Your exits have also been mainly by the capital markets route. How do you deal, and a lot of those companies have continued to do very well, even after you've exited. How do you deal with this discipline of booking returns, returning capital, at the same time keeping the maximum that you can for, the upside coming later on?
Thanks, Vivek. No, it's right. I agree with both Vikram and Samir. See, we are a mid-market, growth-focused private equity fund, and most of our investments are between 10 to 30% shareholding. So while we have the founders are there, which are majority in control, so IPO is a very, very important discussion point at the entry. Because when we are evaluating an investment opportunity, we try to think of exit options and have those conversations in alignment with the entrepreneur. Because it is important that, and we generally invest for 5-6 years, so it is important that over the period of time we are able to work with the founders to tweak the business strategy, business model in a way which such that it becomes more acceptable or more exciting for the public markets when we take them to the IPO. And also from a perspective of the preparation that is required to reach there. However, the preparation starts about 2 years in advance. So actually, when the IPO is happening, you really don't know whether there is a strong momentum in the market or it's going to be a difficult valuation negotiation. What we have kind of maintained the discipline is that if the liquidity event is taking place, we will take that liquidity event and we will not delay the IPO. So we've always gone ahead and done the IPO. What we have done, and we have done everything. In Stanley, for example, during the IPO and post-listing, we have fully sold because we thought that's the right valuation, that's the right approach for us. It kind of helped us manage the DPI. While in Divgi, we sold about 1/3 during the office, and we waited, post our IPO. So Divgi, for example, has given about 40% return to us in the last 1 year. We are right now at about 4x in that Divgi. Stanley was also a 4x for us. In Senco Gold, we did not sell at all, and we sold post-listing for about 3 years. Being an AI, it does help us to kind of time the market in the right way. So yes, we have been very, very careful that so we started giving exits from 5th year onwards from our portfolio companies. Getting your companies listed, at least give that time to exit and post-listing is something that you can manage better. So today, while our DPI in the second fund is about 1.25, some of the listed companies that we are holding right now is another half a turn. So we are fairly comfortable in terms of how we have managed DPI, still hold on to those investments such that we can enjoy the compounding which comes with it. And that's pretty much how we kind of manage the DPI and the IRR MOC play.
So it's more of a art and not a science, and experience will eventually, teach you more and more. Pancham,
I would maybe add one thing. Sorry, Pancham, just if I could, which is, look, the points that were made, fully agree with. I would also just say it's obviously very difficult to time an exit. But one consideration is commercially for the fund. The other is, look, I think all my panelists would agree that, look, it's good for the private equity industry in general as an ecosystem to be selling sometimes and for the stock to continue to rise, right? Because I think, and that's a duty of care, I think as an industry, we all kind of owe the overall ecosystem. And so there is, look, no one wants to sell and suddenly the price is up 4x the next day, but no one also wants to sell and see the price crash the next day, right? So I think, at least from our experience, we've seen a lot of the folks on the buy side actually starting to take a very careful look at the manner in which private equity and venture capital is selling and how they've behaved in those situations. How have they top-ticked? What type of funds have they brought in when they sell and so on? So I think that's another consideration. I know, most, at least as we all chat, it's fairly important and it's good for the industry.
Sure, you got to make it sustainable, completely agree. Pancham, my next question is to you, and request you to bring in a slightly different experience, wherein Everstone had a majority-owned company, SJS, which you listed and then you sold it over a period of time, your entire stake. When you were helping build the company, was it a different thesis than what actually happened? And if so, what changed? And how long did it take from investment to complete exit versus what you guys had thought about when you had made the investment thesis?
Yeah, thanks, Vikram. Look, I think as a control growth firm who's largely doing buyouts or control deals, right, we have fewer IPOs than most others on the street. We are only doing control transactions, which means buying 50, 60, 70% stake or sometimes even 90% stake in businesses. We've done fewer IPOs because it takes much longer to exit that quantum of stake into the markets, either pre-IPO, IPO, and then sort of keep holding it, and ends up extending hold periods. I think the one thing we built as discipline over the last 10 years is our hold periods. We don't hold assets for more than 4 to 4.5 years, right? And we run it like a hard-nailed buyout shop, holding assets for 4 years in and out, right? And that's been our philosophy, which means fewer IPOs, right? There have been one or two IPOs, 3 IPOs, in fact. SJS is one, Burger King is another, and that have been longer holds, right? And at balance, the way we construct our portfolio is there are some positions that could find their way out in 3 years for us to hold some of our positions for 6 years or 5 years, right? But the first priority in our stack of decision making is DPI, and exit velocity is very, very critical, right, to that. SJS was taken public. We held it for close to 6 years, or a little over 6 years, I would say. And when we bought the business, it was a founder-driven business. We bought a large stake, almost 80% stake there. And at that point in time, it was almost impossible to underwrite selling 70-80% stake in the public markets. And that's the beauty of the Indian public markets evolution and the growing depth of the public markets, right? Where you can now actually, and this is something that's happened largely post-COVID, I would say, where you are able to offload 50%, 60% stake over a couple of years or 3 years in the public markets, right? Our initial thesis on SJS was not an IPO. Most of the times when we underwrite our exit thesis, which as a way of rule, we will write a very detailed exit thesis at the time of underwriting a transaction, and we pretty much know who our buyers are, who we need to sort of approach at a certain point in time. We build our businesses generally for a strategic home, right? Because even if I were to sell the business to Vikram at Warburg, when he goes to IC, he will underwrite a strategic exit. Now probably an IPO exit, because that's something that's changed over the last 2 years, 3 years. But at that point in time, when we did SJS, we were all underwriting strategic exits or sale to other financial sponsors, right? And that was the thesis at that point in time. But the public markets sort of re-rating the way that they did, especially for SJS was an industrials business, right? Auto components, ancillary auto parts, etc. The multiples re-rated massively, and even if we had to hold it up for a little longer, the crush in the IRR was more than compensated by the incremental MOIC or money multiple we made because of the much higher multiple we got at the IPO. We made some 6x on that, and still over longer than 6 years, and still were able to be above a dollar IRR of 28%, right? And that was a hallmark exit where we sold a big chunk at IPO, and then we held on almost 50% of our stake post the IPO, and then kept selling in blocks, right? The big decision while we were building that business, and we built a new plant, we institutionalized the management teams from what was traditionally a founder-run business, built go-to-market engines, added a segment. In fact, while we were listed, we also acquired a business in Europe for them, right? And that also helped sort of generate a lot of buzz and a lot of interest in the stock, right? So you have to sort of keep building as if you're building any other business, right? To its strategic goals. And IPO happens as it happens, right? But historically, what we have done as an exit methodology is we've been a great feeder fund into some of the mega funds, right? Selling control stakes into the Warburgs or TPPs of the world, because it's the fastest and most certain way of exiting business, and we would have bought a $20 million EBITDA business, taken it to $50-60 million of EBITDA, and done a lot of grunt work on, governance, and, bringing in professional management teams, building go-to-market engines, adding segments, etc. So that's been our playbook historically.
Great. Thank you so much for sharing that. Manish, capital markets exists for some very different businesses, be it DAM Securities, PVR Inox, or Arvind Fashions. Very different businesses, very different metrics. Can you share with us an interesting story or two on what really happened behind the scenes to pull out these exits?
Yeah, no, thanks. I think all the three businesses that you mentioned, we ended up getting our exits via capital markets, but each of them was a slightly different story. Like in case of DAM Capital, we actually took the company public, and that was always the intention when we invested behind Dharmesh to really take the company public, and that was the intended source of exit. In the other two cases, the businesses were already public when we invested in them, and in fact, with PVR, the association has been, through multiple funds and multiple investments in that business. And both of those businesses actually went through very difficult times at the time of COVID. As you know, I think PVR was pretty much shut. Urban Fashions was also a business which was very heavily impacted, given it was very offline-focused business. And in both cases, we waited till the business recovered. We actually infused more capital, and that obviously elongated some of our holding periods. But I think the entire focus was that we want to be very reliable partners to these entrepreneurs, and wanted to time our exit in such a way that, apart from taking care of the fund's DPI requirements and fund life considerations, which will typically come into play, we want to make sure that we exit at a time where it does not cause any disruption to the business and to the capital market activity in that particular company. So while on the face of it, it looks like they were simple capital markets exit, each of them had very different route to get there and very different circumstances. We also had a slightly different path to exit in PeopleStrong, which was again a Fund 2 company. It's a business we invested in when it was a pure play services business under our ownership. Because it was a controlled asset, we could do a lot of work in building a completely different product business out of it. And eventually, the exit is happening through multiple routes. We sold a small part of the business to ETS. We sold the PeopleStrong product business to Goldman last year, and the RPO business is still under our ownership. So I think in all of these cases, the paramount consideration for us is, what is right for the business, and we want the business to continue to thrive even after we exit, and those considerations were the most important considerations.
Thanks. So as you would have noticed, the capital markets is increasingly playing a very large role in providing exit routes to private equity and venture capital. And as the markets have deepened, more and more PE funds, even those with controlling positions, are looking to exit by IPOing the company and then doing sales in the open market after the lock-in is over. It also ends up competing in a big way for other kinds of exits. And one of the things that, if you notice, we've published the data in the EY IVCA report, is this year the quantum of exits deal via secondaries fell massively, right? And it'll be good to get some observations, some points of view from our panelists. Let me start with you, Manish. Why do you think secondary deals have sort of been not as much in vogue in 25 as they were before?
Yeah, so I think, and I'm sure you're referring to the fact that we did a continuation vehicle, and, that was an important mode for exit for some of our existing LPs. So the whole idea was that we had a portfolio of 2-3 companies which we were very clear that have a very long runway of growth still left, and all of them were very good compounders, and they continue to remain good compounders for us. And at the same time, there are fund life considerations, and we wanted to create more liquidity options for our LPs. And that is the reason we said that, we will take these 3 assets and put them in a continuation vehicle. And because of the quality of assets, we got pretty good demand. So I think our experience is that secondaries have been pretty good for us, right? So that's the point I wanted to make. And I think because of that, we were able to, not only bring some new LPs, honestly, quite a few of our large LPs in those assets rolled over into continuation vehicle because they also agree with our thoughts that, all these assets have a very long runway to growth still left, and we should be able to hold those assets for much longer duration of time. Yeah.
Okay. Pancham, Everstone has had some fairly large exits via secondary deals to other sponsors, whether it's Omega or Sahyadri. When you were underwriting the deal thesis, were they always planned to be secondary deals? How do you guys think about it when you look at exit options for controlled deals like this?
Yeah. So, look, they were always planned either as strategic sales or private equity trades, right? Because of the quantum of stake we had in, both those examples. So, for example, in Sahyadri Hospitals, we used to own 90% stake. Back in 21, 22, to take, a $25 million EBITDA asset and take it public, right, would have been holding it for another three years probably, and that would take your hold to above 6 years. So for us, when we bought Sahyadri itself, we were buying the largest asset in the richest state of India, largest corporate chain in the richest state of India, which is Maharashtra, right? And our exit thesis was quite straightforward, that the large hospital chains, be it Max, Apollo, Narayana at that point in time, and Fortis to some small extent did play in Maharashtra, but there were no large strategics playing in Maharashtra, largely driven by the fact that real estate is exorbitant, right, to build hospital assets here. And it is still one of the lowest bed density states in the country. So our thesis was pretty simple, that, as these large guys who trade in the public markets at that point, 20 times EBITDA, 25 times EBITDA, now it's 40 times EBITDA. But, if they need to continue defending their multiples, they can't do it organically. They need to buy stuff. And if you can't be out of the largest state of India for too long. So you'll buy something. What will you buy? Probably the largest chain. That was as simple as what was our exit thesis in Sahyadri. And we had all the strategics bidding, but private equity guys moved the fastest. We sold because we had an inbound from a private equity firm, and then we started a process on the back of it. But generally private equity moves much faster than strategics, with definitely probably twice as much more certainty than what Indian strategic will give you. And that's how the trade sort of panned out. We sold it to OTPP at that point in time. Same for Omega. Omega was an asset which was owned in the US with our partners, Goldman Sachs there, and the back end was in Asia, right? And that trade was a US trade, always in our mind. It was a dollar-denominated asset on revenues, and with cost in Asian currencies, right? So for us, that was always going to be a US trade, and that traded with, we had interest from a bunch of private equity firms, even from India, because it was owned by an Indian private equity firm, and people figured out how to Indian firms figured out how to, create a story within their internal systems to buy a US asset because of the large India cost base. And we had a bunch of Indian sponsors, financial sponsors show up at the process, and OTPP was again the buyer there, and their India and US offices combined to sort of take that trade. But it was always a sponsor exit for us as soon as we started it. We can't IPO business which is largely sort of front-ended and headquartered in the US with US revenues in India. We can in some form, in like pharmaceuticals. Rubicon is was largely a US focused business and has gone public now. In India was one of our portfolio companies as well. Things are changing, but 2-3 years back, anything and everything was not possible in the public markets.
Yeah, this is very insightful. Thanks so much, Pancham. My next question is to you, Vishal, and then maybe it'll be great to get Sameer's point of view on it. When you're investing in these mid-sized companies, you're taking a minority position. In your framework, what gives you the confidence that they're going to be IPOable 2, 3, 4 years down the line within your investment hold period, right?
No, interesting point, because see, IPOability is a very important assessment that we have to do at a time of exit and entry. So we invest in some of the companies which are small and mid-sized both, especially in smaller businesses which are, in 4 to 5 years of time, one, they need to kind of continue to have the positioning such that the IPO investor or the public market investor are still excited about it. It cannot be that you're a 5th or 6th company getting listed in the particular space. So we focus on businesses which have some sort of a unique moat, which will be sustainable for a 10-year period. So for example, Stanley, when we invested, was the only homegrown luxury furniture brand in the country with design, manufacturing, and customization and retailing ability. It continues to be so, and that is why with even a 440 crore revenue, we were able to get a good IPO 6 years out. Or, if even in a slightly larger segment, for example, Auto Ank, we had Divgi, but the product, so that product and that margin that they carry in that product transfer case is not something which is available with third-party vendors. It's only available with the OEMs or Divgi because of a technology type that they have. This is a moat which continues to be there for a decade. And if that is something, a novelty that you are able to present to the public markets, even in bad non-momentum years, you will have takers for that particular opportunity. Of course, you do invest in businesses where there are other peer groups and other competitors. There you have to start looking for slightly larger businesses, because then you have to look at slight businesses which are at a particular stage, maybe 5th or 6th largest in the segment, but continuing to grow. So we do look at this, that the IPOability has to be there and the interest has to be there for a longer period of time.
Yes, Sameer?
Yeah, Vivek, we look at it slightly differently. All our thought goes in at time of portfolio construction. Typically, we have a concentrated portfolio of 10 to 12 investments, and we don't believe that all the companies can do an IPO and should do an IPO. And we typically invest across a range of outcomes where, the companies that we come in with a significant minority, larger stake, and in 4 or 5 years, they're not going to be large enough to do an IPO. What we have to stress test is there a secondary opportunity available there, or a strategic sale, or a sale to a buyout? And we've done a lot of those. We sold Enamor to Advent, Funds India to Westbridge, our stake in Manipal to Temasek. And in our fund 2, we had a skincare brand, Plum, where we're the largest shareholders. When we invested, it was 8 crores a month. Now they've closed at 500 crores. But the company is not sizable enough to do an IPO, and that was planned. So this year there will be a secondary stake sale where Unilever will sell. We might sell some. And we could also hold and see if when they get to IPO, they sell. And similarly, in our Fund 3 portfolio, on one hand, we have Vastu and Vistar, which we know will be IPO outcomes. But we also have Bakingo and Hangyo, 2 food companies that are doing really well, where we are the only shareholders, and where we've aligned with the founders that there would be a strategic sale or a sale to a PE majority. But one trend that I would add that we are the most heartened about, I'm not so worried about the capital markets. If there are good companies that are profitable it's not always, the markets are not always shut. It depends on sectors. But in the last year, the amount of capital that has been raised by larger PE funds, the global funds, our friends at Warburg, Bain, Blackstone, TPG, etc., who used to have Pan-Asian funds with a large allocation to China, which is all moving to the India program, makes the opportunity for companies that you're willing to sell a full company to a large PE fund is becoming one of the most attractive opportunities for exit. And also, there's a large amount of secondary funds, especially from Asia. They are very active. And of course, the best case study of a secondary opportunity is NSE, where we invested 75 crores in NSE in Fund 1, and we sold 75% of our stake at 10x very easily, and the balance is worth another 500 crores at 30x, and we could sell it soon. So, you know, there's a lot of balancing required, but it's important to plan ahead. Where do you think this opportunity will come from?
Great. We are also short of time. One last question to all of you before we sort of wind up. What's the house view on capital markets this year? Good time for exits, or maybe a time to hunker down and explore other exit options? We'll start with you, Vikram.
The brave man that provides a house view at this point in where the world is. I mean, look, it's very difficult to time markets, right? And I think perhaps one of the most important things that one can do at this point is, A, keep the lens on investing sharp, right? I very much agree with what Sam just said, which is, look, there are moments and times where the IPO window is open, and there are also a whole host of avenues of other exits, which, you know, if you take maybe if I just take a step back, right, offer a global perspective. Look, we have about $100 billion AUM globally. We invest out of a global pool of capital. India today is the largest investment destination for Warburg Pincus private equity outside the US. So I think one of the things, it's easy sometimes, if we're all here, we can get down looking at equity markets and looking at the gyrations in stock prices and so on. But I think all of the growth trends and the secular reasons why India is perhaps one of the few economies where you can actually play growth at scale very much exist. You will see short-term dislocations, but I think what's most important is keeping the lens sharp in terms of investing in quality businesses, and also keeping your lens sharp in growing and compounding your investments, because you will find windows, but those windows won't always be open. Practically, I would just say that, look, even for companies that we are looking to take public, the most important lens is, look, are we doing what we can to support growth and resilience of those businesses? Because you can't always time the market.
Vishal?
No, it's a very, very, very difficult year. We believe that good companies will still find IPO windows, but public market investors, the counterpart is private markets. There's always going to be a valuation bridge which needs to be met. But secondary, I believe the kind of interest that we're seeing from some of the global players in India, we believe 2026 should be a good year from secondary transactions as well. But fundamentally, I believe that is going to be a good year for us finding good deals to invest. Both the SME IPOs as well as the main board IPOs, we believe there's going to be a pause, and those good companies should come to us looking for investments. So I think that way it's going to be good.
Yeah, similarly, I would say that the investing side of us is always happy when there's a capital markets correction. The markets are maturing in the last 5 years from the tech-driven IPOs to profits matter. Profits always should have mattered. And, depending on who you ask, they'll complain about mutual funds. We like that. We like that there's some sanity to markets, profitability matters, selection of companies matters, underwriting matters. So maybe it's a little bit harder this year, but if your companies are strong, you'll find an opportunity to exit.
Pancham?
Look, the house view cannot be 2 weeks old, right? Since the markets tapered off. But, you know, in general, the house viewers buy businesses that are exitable, that is, i.e. in sectors that are structurally strong, EBITDA that compounds every year. Don't miss your EBITDA in the beginning of the investment period, because that's a massive compounding effect that comes in and hits you. So buy businesses that compound year after year, and know your buyers, right? You know, whether it's a sponsor or a strategic, right? We've generally not relied too much on the public markets for exits. So from that perspective, we are a little immune. We have a couple of IPOs lining up, but you know, this is my personal view on the markets is that it's probably going to be one of the better vintages to buy, right? You don't see these kind of disruptions or black swan events happening in the market every day. But the fundamentals of most businesses, and I won't talk about tech, but the fundamentals of most businesses have not changed, right? They've been derated in the last couple of months, right? So all likelihood they're going to bounce back, right? There is no India-specific problem that the markets are seeing, right?
Manish, final words before we wind up. Rajat is giving me dagger looks.
Yeah, no, quickly. So I think our view is not very different from the rest of the group. I think we do believe that IPO remains one of the possible exit mechanisms, but the timing as well as the market environment is obviously not in your control. I think a lot of these things you cannot control. What you can control is your portfolio construction, making sure that the value creation happens year after year. And I think for every investment that we underwrite, there is always an exit option that we think about, which is not capital markets dependent, right? I think it can be a strategic sale, it can be a sale to other private equity player, it can be merger with a larger company, and so on and so forth. So, I mean, from our perspective, I think the focus is on finding the right investments in this environment. Hopefully, capital market, which was such an irrational competitor to private equity, deal flow is probably going to be a little more rational competitor. So that allows us to, you know, really pick some interesting businesses at this point in time. As we have seen in last 5 years, a lot of companies have gone public, and you know, one could argue that some of them did not deserve to go public. So I think a little bit of sanity there is actually quite useful as a private equity professional. And I think we do believe that at least part of our portfolio will be public market steady, and when the markets open up, we will take them public, and rest of them we will find very interesting and variety of exit solutions.
Thank you so much. So there you have it, folks. You have heard it from the experts. There is a time to sow and there's a time to harvest. Maybe 2026 is going to be a great time to invest. Maybe these market dislocations will bring the bid-ask spread between what investors are comfortable with underwriting and what the sellers want. It'll converge, and we will have a lot more deal activity on the investment side in the private equity ecosystem. Thank you for being such a fantastic audience.